We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Britton Financial Partners.
Hi, my name's Adam Dawes and I'm a senior investment advisor at Shaw & Partners. I've been with Shaw's over 19 years and I really love what I do. I do a little bit of media and look, obviously you can Google my name to see what I do, but certainly I do a regular session on AusBiz. I do some work with Channel 7, 2GB Radio here in Sydney. I also do the latest on Channel 7 with Michael Usher, and there's a couple of, and I also do some SBS News. So really my most important role is looking after clients just like you. So what I wanted to talk a bit about today was talk about last year and how the markets unfolded last year, and talk about, and obviously what everyone's really going to be wanting to talk about is what's happening today with the Russia-Ukraine crisis. And then we'll talk a little bit about reporting season as well and how that sort of unfolded, which is just finished as of today. So there's lots to talk about, but certainly last year was a very good year for the markets. And obviously, a lot's going on, you know, with interest rates, inflation, and there's a lot of talk. And if you've been living under a rock for the last year or so, you probably wouldn't have heard the word interest rates, but interest rates is definitely one of those things that has captured the market, as well as inflation. And certainly you can see that inflation right at the moment at the petrol bowser, certainly at $2 or wherever you are, probably a little bit more expensive. But here in Sydney, certainly $2 and going higher. That is certainly a real world inflation. We're also looking at something like fruit and vegetables and meats. Anybody that does the shopping will be nodding their heads at the moment because they're basically seeing costs going higher. And that's real world inflation. So inflation prices are moving higher. But what does the RBA do, or what does the government do to try and stop that inflation going higher? They raise interest rates. And at the moment, we're seeing interest rates at all-time lows. Anybody who's been saving money in the bank over the last year has pretty much got zero for that. And our interest rates are at 0.10, so 10 basis points. So with inflation starting to rise, we're actually now starting to see the banks, or the central banks of the world, thinking that we're going to have to raise interest rates to keep inflation in check. And that's certainly one of those things that we're seeing from a global perspective as well as here in Australia. Overseas, they're expected to raise interest rates another 7 times in the next year going forward. So that is going to be a really tough spot for equity markets. But here in Australia, we're expecting to raise at least twice, whether that's in June or August. Equity markets don't like interest rates going higher because equity markets like free money. And that's exactly what's been happening over the last couple of years, is what is called quantitative easing. That free money has definitely been being pumped into the system. Now that's all stopped, and now interest rates are going up. So there's going to be an adjustment in the equity markets, which obviously there's going to be a little bit more volatility. And that volatility will then provide opportunity for investors. Now, if markets just went up every 2.5% every year, nobody'd make any money. But volatility is something that we can hang our hat on, and we can say, well, we know that there's going to be some more volatility coming forward. One of the other things to show for interest rates being risen or rising is wage growth or wage inflation. Now, wage growth has been very anemic in Australia for the last, let's say, 5 to 10 years. Nobody's really got a pay rise. Nobody's really getting any extra money. But now we're starting to see that wage inflation starting to come through. Companies that are trying to attract somebody, they have to pay overs or have to pay a little bit more to get that new employee onto the books. And certainly that's where wage growth starts to move. And there, again, is another indicator of why interest rates are going to start to go higher. So last year, we certainly had a good year in the markets and we're really comfortable with what's going on. But now it becomes more and more important that you speak to your advisor about getting in touch and sort of working out where the portfolio should be going and planning for the next 2 to 3 years. This is where all of the guys at Burke Britton are the ones to talk to, because they're the ones that know your personal circumstances, and they're the ones that you can say, okay, I need you to put my portfolio under the microscope and let's see how we're going to go for the next 2 to 3 years. So I think it's going to be more volatility going forward, higher interest rates. But I think, and we've seen this correction over the last January, markets were down around 6%. And we've seen, obviously, with the Russia and Ukraine crisis, our markets have also fallen again on the back of that. So what happens is that, or what I'm calling this is calling a mid-cycle correction. We've had our fall back in March 2020. The markets fell. We've rebounded back above where we were in March or before March. And now we're starting to see a little bit more volatility. And I think this mid-cycle correction is okay. It's part of normal market cycles. And I think that we've still got another 2 to 3 years of good market conditions before we have to worry about the R word. And that R word is recession. And certainly...
Russia.
Yeah, that's a good one as well. We're already worrying about Russia now, but that R word, recession, and I'm not too concerned about the first 2 interest rate rises. That doesn't concern me. It's the last couple of interest rate rises that will get markets unnerved, and that could take another 2 to 3 years for that to get there. So pretty comfortable with all of that.
I suppose
now,
quickly to cut in on that. So is it going to be a slow process? Is where people don't need to be spooked out about this being something that's happening in the next 3-4 months, like you said there.
Absolutely,
it's going to be an adjustment period.
Absolutely, and that adjustment period is where you see the headlines, oh, markets fell and billions wiped off the market. But obviously, when you've got good financial advisors and you've got good advisors in your corner, this is where we earn our stripes. This is where you need us to come back and tell you not to panic. That's the first thing I say to clients when they ring me up and they're going, Adam, what's going on? I'm going, look, let's not panic, because history says that, yes, there are these blips, but overall, if you sold down at the bottom and then tried to get back in as the markets rally, you've missed your opportunity. So having a little bit of powder dry, having a little bit of money on the sidelines to take advantage of this volatility, I think is very, very important, not to be fully invested, but also to see those opportunities as they come along. So obviously we're seeing this crisis, or this Ukraine-Russian crisis, which really shows to me how this world, or we are seen as a global world or one world, because it's now showing how sanctions are being put across all of the financial institutions around the world, and certainly Russia is definitely being outed for doing this. But what we did see is Australia was one of the first markets to react to the news of the Russia-Ukraine crisis, as we were the only market that was pretty much open, because Europe was asleep, America was in nighttime, and basically we needed to make sure that we had everything under control. So what has happened now is that we've seen our market, we've seen the rest of the market start to fall, to take it, obviously, with what's happening in Russia. Now, how do you play this? What do you do? Well, it's a little bit called flight to safety. And that flight to safety is that you could potentially look at gold in your portfolio. And I know that we've got some gold stocks in the portfolio, and they've done very, very well. But also oil has done very well. And that will continue to do well as long as this crisis is going to happen. So Woodside is certainly something in the portfolio. I know we've got a little bit of Santos with some clients, but oil and gold are those flights to safety areas. And dare I say, for those clients that want a little bit more oomph in their portfolio, we've seen the tech stocks getting absolutely smashed over the last sort of 3 months or so. We're starting to see some value in some of those international tech stocks. Those tech stocks are actually looking quite good, and we can start to buy into some of those. For the likes of the Australian, it's the megaports of the world, or even we could look on the international side for Google, those kinds of things. I think we might leave Facebook out of that one for the moment anyway. So yeah, look, tech is certainly something not for the faint of heart, but that's certainly, but flight to safety is certainly where we're seeing the market going forward. So again, don't panic, everybody. I think this Russia crisis is going to get solved. I don't think it's going to be a contagion where it will go into the rest of Europe. I think everybody will have some sane heads about them, and they are now day 5 into the turmoil. But we are talking, or there is some peace talks potentially coming through. So yeah, it's a really interesting time for the markets. We're certainly on a little bit of tenterhooks, but we will see some more volatility coming. I think that just provides opportunity. Now, one of the other things that I wanted to talk to you about was the reporting season, or a reporting season wrap. We're about 98% way through reporting season, and that's where all companies have to basically tell us how they've gone for the last 6 months up until December 30, 2021. So has now come through, and the amount of beats versus the misses, we saw 4 companies beating versus 3 companies missing, so 4-to-3 ratio. That's actually not too bad. It's a little bit less than what we saw in the previous reporting season, but this is a full year of COVID and companies starting to get to understand what is going on. But we certainly saw the market earnings upgrade for 2022 up by 2%. Now, that doesn't sound a lot, but that's across the entire market. So I'm really comfortable with that. some of the metrics that I look at when we looked at that reporting season wrap is what sectors most impressed me. And one of those was the energy sector. And we just talked about that Woodside side of things, or oil. And the financials did really, really well. Commonwealth Bank absolutely killed it on their report. And it was a fantastic top line growth that we saw. One of the things about the banks is that if interest rates start to rise, the banks will do quite well, because what it is their net interest margin, the NIM. Now, the net interest margin is the difference between what you bought it, what they buy their debt for versus what they sell their debt to us for. And that's the difference in that margin. Now, with interest rates been falling over the last 5 years, and we're at anemic interest rates of 10 basis points, that net interest margin has been shrinking. But what is happening now is that net interest margin is going to expand. And we expect up to 25 basis points of that net interest margin to move higher, as well as that means over the entire banking sector, which is the top 5, so top 4 plus Macquarie, will be another additional $5 billion in revenue, not for one company, but across the board. So that is going to be a big boost for the banks. So I really like the financials in that reporting side of things. Another side of it was the supply chain and labour constraints. And where were those key headwinds that we saw? Then there was a lot of supply constraints, and we saw Woolworths and Coles getting hit on the back of that. One, their basket size was getting a little bit smaller because everybody is now doesn't have to eat at home. They can go out to a restaurant. So their basket size got a bit smaller, but also the supply constraints. And Woolworths actually came out and said that they're going to hold on to those supply constraints, and they're not going to pass it on to the consumer. So I think that was quite a good one. Coles probably reported a little bit better than Woolies, but also I saw Wesfarmers. Wesfarmers reported really, really well. And for the first time in many, many years, Bunnings revenue pulled back a little bit, down by 1.2%. But look, hey, sausage chisels will always be a favourite going forward. So look, supply chains and labour constraints was certainly one of those things. And then the next thing that I looked at was companies that show impressive cost control and the ability to maintain their profit margin. And I mentioned Coles before. That was certainly one of those ones that did very, very well. Another one of those companies was Goodman Group in the property trust sector. That did very, very well. And a company that we probably don't invest in, a lot of you guys, but their profit margin was absolutely fantastic, which was Lovisa. Lovisa is, you might have seen them in the Westfield shopping malls, but it's basically fancy jewelry that women buy and they wear it once and then they throw it away. So look, their profit margin was absolutely outstanding as well. So there's a little bit of a wrap about the reporting season, a little bit of a wrap about what's happening in Russia and Ukraine, and then obviously last year as well. But I expect this year to be quite good. I expect this year we will see more volatility, but I'm really, really comfortable with the portfolios that we've got for you guys. I'm really comfortable. We're watching them all the time. We're doing reviews for you, and you've got some fantastic guys there in your corner with Burke Britton. So anyway, thanks so much and have a fantastic day.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.